property and precious metals in your portfolio, a match made in heaven. Hi everyone and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto and the Gold Silver Standard. Today we have a very special guest. We've got Kane here from Discover Buyers Agency. He's going to talk to us about property, which is seemingly not initially related. You go, oh, why are we talking about property on a bullion sort of podcast? But there's so much relevance here, and it was really interesting talking to Kane about this in the lead up. So I'm very excited to dig into this today. How are you going today, Kane?
Very well, thanks, Chris. Great to be on the show. It's been on the bucket list for a while.
No, I'm so glad to have you here because, like, it's interesting. First of all, if you're like me, you didn't really even understand what a buyer's agent was to start with. So there was all that sort of background of what you were doing, but then you've just got this interesting take on how it all fits together when we talk about precious metals as well. That you've brought along some charts today to dig into and talk about what's going on in the Australian property market that I think people will be really interested in. It's going to be a great conversation, I think. But start us off, give us a little bit of your background and what you do.
Yeah, so going back 20 years, I purchased my first property as a young investor, and that's what sort of triggered the whole journey for me. I was in a completely different industry, and then just sort of slowly started learning and building the portfolio to a point where I wanted to transition my career to be closer to the transaction of property. Buyers agents weren't very common back then, and I liked the idea of mortgage brokering. So I started a business as a mortgage broker. So I had the big four banks and 30, 40 other lenders on the panel. And then as we continue to build the portfolio, I guess the mortgage broker would provide the loan, but then the client would have to go source the property themselves, and there wasn't a great deal of knowledge in that area of sourcing and where to buy and why. And then we transitioned to a buyer's agency to help people with that buyer side, and we wrapped up mortgage broking. So we're licensed in WA and to Queensland and everywhere in between. And we use a lot of data and research to help people identify the right market to be buying in for their unique position and portfolio.
And I can't wait to dig into that data because it always fascinates me, and it really is quite in depth, the data that you have behind the scenes that makes all of this work. But I suppose the thing that most appeals to me about how you see the world is your view of property and gold and silver and Bitcoin as well. I know you're also interested in the crypto side of this, all fitting together as hard assets. Can you give us a little bit of an overview of your perspective, how you see property, how you think about your personal portfolio? How does that all fit together for you?
Yeah, so I guess, to like that hard asset is that store of value outside of that debasing currency. But the thing with property is we can leverage against it to acquire more. If we go back to around that 1970 mark in Australia, I think the average house price is around $12,000. And doing a bit of quick research this morning, for a kilo of gold is around 1,688, or where my research was at, this morning. Very quick, but so in 1970 it took about 7.1 kilos of gold to buy the average house in Australia, and that's Australia wide. Fast forward to today, the median household price, looking at all capitals, is 1,054,000. Right, so looking at the Ainslie website as well this morning, a kilo of gold was around 152,000. So today it's about 6.93 kilos of gold to buy that median house in Australia. So there's a difference between the 54 years or 55 years of 0.17 kilos of gold, and I think we can put that down to where we source our data from, the time exactly, the provider. So property provides to be a very good hedge or store of value, but it's its ability to borrow that devaluing dollar, to build multiple properties, because I guess the banks are a lot more favourable to lending against property than they are potentially, your gold or silver or Bitcoin. We're not there yet with Bitcoin, it may come. But as properties, it's not all beer and skittles, I guess. We have to manage it like a business. There's a profit and loss, rent in, repayments out, rates, insurance, and I'm sure land tax may come up. And also we've got our balance sheet as well. So we have to manage a property portfolio more like a business then there's passive ways to do that and active ways. But traditionally precious metals are a lot more set and forget, which is very appealing to some people.
And what we've found is really interesting as well. There is this interconnection or ability to use property and precious metals together in quite interesting ways. We've had people who, for example, are moving between properties, want to park their money somewhere, don't want to park it in a bank. And we know the complexities that are involved around people using banks to access their own money. Like it shouldn't be complex, but it's a process. It can be a complicated process. So we've seen people do that type of thing before. It's fascinating to me that when you do that comparison over that very long period of time, that property and gold have both sort of performed similarly there at holding that value. Do you find in your travels, in your discussions with people, that there have been people really looking for alternatives outside of the traditional banking rails when it comes to dealing with this?
Probably on my side, on the property side, I get less that want to be outside of those banking rails, where I might get more exposed to people that are open to both asset classes and building them together. Whereas I'm sure like the typical client on the Ainslie side may be more looking to do it outside of those banking rails. But there's a few options. You can take that strategic approach where if we look at the average Australian house price, 1,054,000, and they might have a mortgage, depending on how long they've owned it, from 2, 3, 400 to 6, 700,000. They can buy another property and then hold that property through a strategic cycle and then sell that other property when, and we can look into some of the data. And then if they can buy $1 million property, it doubles in value, sell that property, they can clear their mortgage and park 500,000 in precious metals. And then all of a sudden by leveraging into another property, they can reduce their debt and have a lump sum into the precious metals. But it's about planning that acquisition and buying in the right market to do it. We could also have an example with a bit of lazy equity, and this is probably more suited to the gold bug, I guess. They've got their home with $1 million, and we'll keep using that average price in Australia as an example. And they've almost paid their property off. They might be at $100,000, $200,000 of debt. They can, if they're still working, go to the bank, borrow up to 50, 60, 70% of that property's value, pull out $500,000 worth of equity. It would be used with an interest-only loan, so it would sit there in that offset account, so there's no repayments until they draw it down. Then they can dollar cost average into gold and silver. Obviously, they've got to manage that cash flow of that facility that they're using to do it. Or they can even, depending on their cash flow, there could be empty nesters where the kids have recently moved out and their cash flow is slightly increased. They can take a lump sum of that 500,000. They may choose half, 250, buy a lump sum in precious metals, and then dollar cost average with the balance of the 250 for the next 5, 10, 15 years. And then you've got probably more of your traditional property investor, and they're looking to buy and hold a property portfolio and build it over time. But the common downside to property is the liquidity. But if we can buy a property using that, similar to the lazy equity investor, they pull out that 500,000 and they may split that up for 2 or 3 deposits. But each property purchase that they make with that as a deposit, they could acquire maybe 5% of that property's value in precious metals. So then they've got, 50,000 of gold sitting as liquidity to their overall portfolios. Then all of a sudden we're not a property investor, but we're a property investor with precious metals attached.
And I absolutely love multiple of those examples, but particularly this idea that you can use the leverage that exists in your property to gain some liquidity almost ahead of time at a very low cost, because that's ultimately, in my mind at least, the biggest value of property is that you can borrow against it. You've made that point really clearly at the lowest possible rate. Like that is the best loan you can get. And if you've got the capacity to borrow that money and you're very confident in precious metal play, for example, you're just not going to be able to borrow money to do that in any other capacity. It's a really clever way to do it if you were minded that way.
That's right. But you just got to manage it like that business that I was saying with, be aware of your cash flow, I guess.
Yeah, for sure. Well, look, I'd love to dig into. You've brought some charts along, and some of your background tools. These are really fascinating to me, and I think they will be to anyone watching because they're not something that everyone has access to. They're sort of the special sauce, if you like, behind what makes all this work. So, can you talk us through a little bit about what's going on? I thought today specifically, if we looked at the Australian capitals and what they're doing, because I just find this stuff fascinating.
Cool. So if we look at the Australian capitals and we break it down by quarter, in the last 3 months, Australia-wide's moved at 1.3%. But over the last 12 months, it's about 7.1%. And this is the September quarter of 24. But then the bottom quartile is the fastest growing. So 2.3% versus 0.5% for the more expensive quartile of the Australian property. If we fast forward to December 24, the last 3 months was then at negative 0.1. The rolling 12 months was 4.9. So we can see a significant slowdown on the national average in the last quarter change. And then again, that more affordable quartile was 9.9% versus the more expensive quartile at 2.1. And then if we take the similar data from February, we're not quite at the end of March, but February we could see the 12-month average was down to 3.8. And the regions or the non-capitals are outperforming our capitals. So over the last 3 months, the capitals were at 1%. The regionals were at 1%, and the capitals are negative 0.4%. So we can definitely see the two themes there are the more affordable areas are outperforming the more expensive areas, and then the regionals are outperforming the capitals. And we can dive into each capital. We can actually break that down, and you can see on the left we've got our 3 months data, and then on the right we've got the 12 months data. So we can see the 3.8 with the regionals that did 5.5 over the 12 months, and then the capitals doing only 3.2. And we can break that down by state as well. But if we go that one step further, we can see a chart for each capital, and you'll notice on Sydney here around that February 22, where the peak or the high of the annual change, and then each bar represents month-on-month growth, down to the negative 10% here. That's that interest rate rising cycle. So we could overlay this with your global liquidity heat map of the Reserve Bank of every country, and we could see that this would, if we could overlay it, it would probably line up with your shades of red transitioning through our shades of green. So as interest rates, I think it was 13 rises over 15 or 16 months, that there was just increase after increase, and that's as that consumer confidence was decreasing as interest rates were increasing. And then as soon as there was that pause, we could see the market started to move again in Sydney. We can move over to Melbourne. And you can see Melbourne, same theme, had that huge pullback or slowdown in interest rates as interest rates increased. But we can see for the better part of the last 3 or 4 years, Melbourne's trended sideways, and it's really they've brought in additional taxes and rights for tenants, and it's quite an unfavourable environment for investors at the moment. So
I want to just ask you on that, because we recently did an Insights where I was talking to Katrina about specifically the Victorian thing, and we got a lot of feedback on that. The people going, it is quite ridiculous there. Is that what this data is showing, that there is a bit of a trend there, that people are going, that policy actually matters ultimately in prices? Are people moving away, particularly from that investment side of things? How you see it?
100%. There's extremely low confidence through all land tax, but it's kind of, I feel that there's a lot of FUD there, and it's people are making decisions before investigating. So we purchased a property for a client in Melbourne, in a Melbourne suburb, just recently. 60,000 purchase price, a bank val of 690. his land tax for the whole year is going to be $975, whereas Victoria has quite cheap land rates as well. So if we were to compare that to some land rates in Queensland, it's much of a muchness. So there's a lot of flood, and it's almost that environment of be greedy when others are fearful and fearful when others are greedy. So
So there could be opportunities presenting themselves in Victoria on the back of really a change that's going on there.
100%. I'll show you some more data further once we get through these capitals that will sort of highlight why we're a bit supportive of Melbourne as a potential opportunity over the next few years. So Brisbane, we can see very similar. However, the negative was quite small, and then more consistent growth over the last several years, and Melbourne being negative 6.4% from the highs, whereas Brisbane's currently sitting at all-time high in median house price. And then we can see Adelaide, even smaller pullback, and then Perth again. So Adelaide and Perth and Brisbane are all sitting at all-time highs. And now is the first time in Australian history where Melbourne is not second to Sydney. So Adelaide, Brisbane, Canberra, Perth are overtaking Melbourne in median price. So the question I pose to many people is that sustainable? Or is this short-term FUD around land tax and policy changes? And are we missing an opportunity?
Fascinating, because I've I wouldn't have thought that at all, and I think a lot of people will be very surprised to hear that Melbourne has dropped back there. That would be surely relief. I mean, part of the discussion that we were having when we were talking about it was the issue that it creates for rentals if you don't have favourable policies that ultimately do those properties end up coming back onto the rental market. Like there's issues around that, but certainly that's really interesting to see your data on that, sort of beyond the perspective, your data on that to show that, wow, there potentially is some opportunity there in Melbourne.
I very much agree that the policy environment for Victoria is very favourable to tenants and unfavourable to investors. But we've got to also consider the opportunity cost of making a decision to not invest there, I guess. So we might bring up another, like a data provider, and look at some raw data and see when we're picking a suburb, there's 7, 8 states and capitals. But there's probably 15,000 suburbs Australia-wide. So we don't just go buy an altcoin in the crypto world without doing a bit of research, and I'd hope that a suburb is very similar. So, with your altcoins, you're going to look at, I guess, max supply, list a few others for me, circulating supply, market cap, the team
You got to look at the team behind it. So that's maybe your government in this case. I love that we're going down an altcoin analogy for suburbs in Australia.
Well, 15,000, there's so many to consider. So what we'd do is come down and maybe use a process to filter those 10,000 suburbs. So we'd put in a bit of a price bracket. We'd say we want high and medium confidence data. So that's going to eliminate things like mining towns or high net worth suburbs where the data and the sales history is few and far between and high variance. So we don't want to rely on that for our investment decisions. We'd say we want the affordability index to be under 40. So that looks at the median household price and the median household income, expresses it as an index and says how affordable is this area. Because if it's highly unaffordable, it's unlikely there can be mass purchases there and create that competition environment to drive prices higher, because they're already high if they're unaffordable. We then say supply and demand obviously impacts price of anything, and the suburb's no different. So we want to be in a low supply area. So stock on market expressed as a percentage is how many properties are on the market for one suburb of how many properties are in that suburb as a whole. So we'd say we want to see less than 1%. Inventory is kind of like stock on market, but it's expressed as how many months does it take for the current demand levels to absorb all that supply or all that stock on market if we were to say no new listings as of today. And in this case, 1.5 months or less. Anything under 3 is good. And then BA ratio is our building approval ratio. So that's incoming or new supply, whereas the stock on market inventory and existing supply. So this could sort of be looked at as your stock to flow in the precious metal world.
Right.
Then we want to look at, so we've got low supply, we want to make sure there's a bit of demand there. And we want to look at days on market, and that's just essentially how quick are they selling. Vacancy rate, so vacancy rates when they're low, rents are increasing. When rents are increasing, but we're in an affordable area, tenants are going to become buyers, and then investors are going to see rents increasing. So investors are going to come and buy, and that's what creates that growth performance beyond the long-term average for that shorter period of time. And then vendor discounts, another one that we've just added in the end. And we can see we've come down to 150 suburbs out of over 10,000 that this provider has. So we know we're in a pretty good list of suburbs that we've shortlisted, but then we want to have a deeper dive into each suburb. And we can see, say, Badumba here in Queensland, done 138% over the last 10 years. So a term that you would be familiar with would be like mean reversion. So we have an average because we always have the high and the low point. So we could say that this is out, like Australian property over the long periods of time, probably 6.8% per year that it increases. But obviously that's, not a perfect straight line. There's highs and lows. So this has done 13.8 for 10 years. That's well and truly outperformed that long-term average. So we could expect to come into maybe a flatter period and revert back to that mean. Whereas if we look at Abbotsford here, 19% over the last 10 years. So it's drastically underperformed the long-term average over 10 years. But we know we've got high confidence data. It's affordable. So when people are ready to buy, and we're talking predominantly own occupiers because they're going to drive prices, we know there's a low stock environment and demand exists. It will revert back to that mean, but it will go beyond that mean as well. We're going to take a hit on yield because we can see 785 for a 1.2 million purchase. But it's unlikely that this can sustain such low growth. It's that question of, is Melbourne really going to be number 6 in Australia? Or will it pull its way back to Sydney, Melbourne, and then everyone else? And we can dive a little bit further into this market. And this is only one example. We can filter this to a client's needs or a buyer's needs based on price. If they own multiple properties in Melbourne, we may look elsewhere and things like that. Yep, so here we can see we've got high confidence data. There is a bit of a yield suppression with only a 3.35 with a median price of 1.2 million. But then if we come down, we can see we've got an economic diversity of 70, so it's quite a diverse area. It's close to Melbourne's CBD. Infrastructure spend is at 3,350 per capita. So when we look at infrastructure spend, we want to make sure that we're a suburb with 10,000 people versus a suburb with 4,000 people, or a suburb with $1 billion worth of infrastructure spend is being compared on an apples to apples. So when we express it as on a per capita basis, we can understand, and that's quite high. We can then come down and see the long-term 20-year chart, and this is here we've got the 19% over 10 years, and then the 1 year's -6. So we can see it's under that long-term average, and then there's many other factors so we can check. So the index relative socio advantage or disadvantage is quite an affluent area. So 10 out of 10. So we know we're in a good area to be buying. And here we've got our supply and demand metrics where we can sort of look at, we know we're in a low supply market with strong demand, but we want to check the trend lines as well. So we can see on the left here in the purple, we've got the stock on market. So there's less and less and less stock available to buy in this suburb, and days on market's fairly flat, but we can see it's already at 21. So anything lower than 30 is they're selling quite quick and they're getting good prices. 30 to 60 is fairly balanced in days on market. So we can see, this like a median price of 1.2 million. There's a high probability that in 4 to 7 years' time, we could get a good double out of this. And that's that mean reversion piece.
And it's just so fascinating to me that when you don't know much about this space, you would just go, oh, I like I like the sound of a suburb, or I like the sound of a state, and you can dig right into the specifics. It's absolutely fascinating and useful to be able to dig into that level of detail, because I think obviously that makes a huge difference to the performance when you're thinking about this as an investment, not necessarily just, if it's a place you want to live, that's a different story. But when you think about investment, you look at it from the investment angle.
And that's a very clear little approach of, if we want to top up our precious metal position, where can we go buy where we're going to get a good double in a shorter period of time by looking at that 1, 3, 5, 10-year growth marks to see where it is in its cycle. Because I tell you, if Bitcoin, precious metals and property all moved in an exact straight line with a long-term average, never deviated, it would be a lot easier, wouldn't it?
Well, absolutely. Look, I have one other question, because this is something that plays on my mind quite a bit, and I just need to ask that while you're here. We've got this generation of first home buyers who feel that affordability has just priced them out. I've been saying that a way around that for them is to start with whatever you can, accumulating, in this case, precious metals. Like I say, get, or crypto for that matter, start accumulating some sort of asset, because the asset prices keep going up. The only way you can play this game is by having some assets, because your wages aren't necessarily going to keep up with that over time. We know that's an issue. How do you think about that? What advice do you give people if they feel like they might be watching this going, look, that's all good. If I had money, I'd be able to do that. I don't have money. How do I approach it?
Yeah, I guess I 100% agree with, get out of that fiat currency class. I won't call it an asset, but get out of fiat currency and get into some sort of asset that's smaller and lower barrier of entry to get into. So you're at least moving into that, potentially that hedge position. But go speak to your parents and their grandparents and ask what it was like for them to buy when they were trying to buy their first property. Because today you can buy a property with 5% deposit. You'll pay no lender's mortgage insurance. You can pay no stamp duty. You can get a $30,000 first home owner's grant. So 5% is all you have to come up with to get in the market. And what we were looking at, that data, there were suburbs there for 600, 700,000 medians. So you could buy below that median and you can get in their houses. That's not units. If we open units, the barrier, 5% using all those different grants and entitlements that you can get access to. Whereas if we go 1987, interest rates were 17%, and you would have to come up with at least 10, if not 20% deposit. So just go speak to someone from that generation, and the common theme across generations and decades is everyone feels the same as the generation do today, that it's beyond reach, I can't get in, it's too hard. But I guess the first step is making a plan, because if we don't have a plan to get where we want to go, any road's going to take us somewhere.
Look, I think that's fantastic advice, and it's been so refreshing actually to hear your perspectives on a lot of this, because some of them are a little bit different to what we might have thought in some areas before, that you've backed up with some data. So really appreciate that. It's useful insight, and we'll definitely have to get you back on again to dig into some other areas and things. So we need people to provide some feedback there too, like in the comments, about what you want to know more about in this space, because that data, I just think, is the most valuable part of all, having access to. I mean, you showed it in real time there, what information that provides and the value that provides by having access to that. So certainly leave some comments in the spot wherever you're watching this, so that we can feed that back through. Sort of wrapping this up, if anyone wants to get in contact with you to speak more about their suburb or find out, particularly those young people who might have gone, I had no hope, but now, Kane's sparked a little bit of inspiration there. How should they do that?
Yeah, just discover buyersagency.com.au, fill out the form or find out details there and reach out. Always happy to have a chat with anyone, especially my biggest passion is helping young Australians get into that property market and then build their portfolio, whether that's incorporating precious metals or whatnot, using the safety and security that property provides. I love those conversations, so please don't hesitate to reach out.
Look, absolutely fantastic insight, absolutely fantastic data and analysis. Thank you so much for your time and digging into that today, Kane. We'll definitely have to get you back.
Excellent. Thanks so much, Chris.
Thank you, everyone, for watching. We'll chat again soon.